Hi there and welcome to my Q2 2023 market update, where we have a look at what has transpired in the second quarter of 2023 when it comes to global equities, Australian equities, global property, fixed income and general policy. We'll be having a look at what has transpired, how we are positioned and how we see markets going forward for the remainder of 2023 and beyond, where we see different opportunities across global markets and different asset classes, as well as some general policy and general strategies that you should be aware of going forward. So let's dive right in and let's start with a bit of a look at what has happened in global equity markets. So beginning with global equity markets, it has been a thrilling ride over the last 6 months. We have seen the 7 tech giants in the United States up about 50% collectively since the beginning of 2023. The total stock market index, excluding Australia, is up about 7.5%. So what does this tell us? Well, it tells us that the majority of the heavy lifting, the majority of the recovery we have seen since the beginning of 2023 has really been driven by these 7 tech giants. The introduction of ChatGPT and the other AI technologies that are continuing to evolve and continue to be developed has, of course, shone an even greater spotlight on this sector and on these companies as well. A number of them are very well positioned to benefit and profit from the growth and future investment in this space, and we do expect that future earnings have really received a strong boost from the introduction of these new AI technologies. Now, we have seen positive growth in the remainder of the market as well. So looking outside of the technology space, growth in healthcare, growth in financial services, despite the headwinds we have seen with Silicon Valley Bank and a number of others, and growth in consumer staples. This has also been evident in Australian equities, where we'll have a bit of a look at what has happened in the Aussie stock market shortly. But globally, we are seeing a bit of a recovery as central banks near the end of the rate rising cycle. The cost of living pressures have obviously received a lot of attention particularly over the second quarter of 2023. Despite the fact that inflation is trending downwards, particularly in the United States and in Australia, central banks have really kept their foot on the gas when it comes to ratcheting up interest rates. The key objective is really to bring inflation to their targets of that 2 to 3%, particularly if we're looking at the RBA, and they clearly are destined on getting this done as quickly as possible. So what does all of this mean? Well, it means that those companies with high levels of debt, those sectors that are not well funded or are more exposed to particularly consumer demand softening in the event that cost of living pressures remain, those companies are very likely to remain fairly soft and even weak going forward. Those companies and sectors, however, that are more resilient, that have reasonable cash balances, low levels of debt, will very likely do well going forward. So we remain quite cautiously optimistic and even quite bullish on those key sectors around technology, cybersecurity, of course, as a bit of a subset of the technology space, healthcare, consumer staples, particularly as populations increase. We do expect that those sectors will do well, and even financial services going forward. Yes, we have seen a bit of volatility with Silicon Valley Bank and a number of others, but we believe this has created opportunities for investors, particularly with a medium to long-term outlook. So that's a bit of an update on what's happened with global equities. We are cautiously optimistic, but of course selective with what we're investing in. Let's have a bit of a look at what has happened in the Australian equity market throughout the second quarter of 2023. The Australian market has shown a lot of resilience throughout the first half of 2023, and this has remained evident in the second quarter as well. The Reserve Bank of Australia and Governor Lowe have very much been destined to drive inflation down into the ground as quickly as possible, and that was really evidenced by the last rate rise we saw in June of 2023. We are now at some of the highest cash rates we have seen in about 12 years, and a lot of mortgage holders have never seen a rate increase throughout the life of holding that mortgage. So these cost of living pressures are obviously getting a lot of attention. And of course, we've all heard of this mortgage cliff. Now, is it likely that that is going to lead to a drastic sell-off in Australian property prices? It is very, very unlikely. With strong immigration growth and record low supply levels of both new property, particularly with the number of builders going bust, and of course, just a general lack of supply of listings of quality property. Again, this is all continuing to remain or retain a lot of strength in the Australian property market. So very unlikely that we're going to see any real weakness despite the cost of living pressures. We have seen both normal commodity prices and agricultural goods prices remain very strong in Australia, and the reopening of the Chinese economy following their lockdown measures from COVID-19, as well as the more sustained growth of the Chinese economy. And of course, they're wanting to keep a bit of a lid on the Chinese construction, Chinese property market and have a more diversified economy, particularly one that is more demand-led internally, will likely benefit Australia in the long run. We are also seeing strong demand amongst international students and, of course, immigration policy into Australia as well. The forecast is for about 900,000 additional people to reside in Australia over the next 24 to 36 months, and that is obviously going to lead to more demand for financial services, healthcare services, tourism, consumer staples, and a number of other sectors that will be beneficiaries from this strong growth as well. So we remain fairly bullish on the Australian equity market. The Australian dollar is also relatively weak, and as we near the end of the rate rising cycle in Australia, that will likely lead to the Australian dollar remaining relatively soft or relatively attractive against the Singapore dollar and, of course, the US dollar as well. So plenty of opportunities that we see in the Australian equities market, and a great opportunity for Australian expats to be repatriating funds or even just shifting funds from Singapore dollars into Australian dollars within their Singapore investments. Let's have a bit of a look at what is happening in fixed income and where we see the opportunities there for investors. The fixed income space and both the corporate and government bond space has been a very challenging sector over the last 2.5 to 3 years, particularly since COVID started and then further exacerbated by inflation rising and central bank tightening as they've ratcheted up interest rates. Now, as we near the end of the rate rising cycle, we are starting to see some more attractive valuations and attractive opportunities to position more of the defensive part of portfolios into some attractively priced bonds. Now, within that space, we are not terribly bullish on junk-rated bonds or some of the more speculative emerging market junk bonds or emerging market bonds in general, because we do remain a little more concerned or perhaps just have less clarity around what central bank policy looks like going forward. But there are a number of opportunities in the developed market space, and those yields are starting to look quite attractive. So we expect that the next 3, 6, and 12 months are going to present some pretty good opportunities for investors in that fixed income space, and we do expect that the recovery in a lot of those bonds will continue over the next 12 months. Let's have a bit of a look at the property space and where we see opportunities there going forward into Q3 and beyond. The property space in the second quarter of 2023 has been very mixed. We have seen the residential property market in Australia showing signs of strength over the second quarter. We have seen mixed signals from residential property globally, and of course some cooling measures in terms of property introduced in Singapore and the crazy rental situation starting to subside. Now, of course, the outlook for office property remains very questionable and quite bearish. Nobody is really quite certain around what office occupancy and what staff policy is going to look like in terms of working from home, this sort of hybrid arrangement going forward. And I think whilst unemployment remains relatively low, it remains unclear exactly what that will look like going forward. We are seeing more and more demand amongst corporate tenants for more sustainable ratings of office buildings. Naturally, that is going to become more and more important amongst both staff and investors, so we expect that demand will continue. What does that mean? Well, it means that a lot of those corporate landlords and those commercial property owners need to look at more and more new developments and start to recycle out some of the older properties within the portfolio. So within the global property space, we remain most bullish on the industrial, the logistics side of the real estate space, and a little more bearish and pessimistic perhaps on the office space at this current juncture. We do expect that there will be opportunities there going forward, but at this point in time, we remain quite cautious. So that's a bit of an update on what's happening in real estate. Let's have a look at a bit of a summary on what's happening in terms of general policy and general updates. So a few other items to be aware of. In Australia, we have just entered the new financial year. So there are a few things to be aware of. Number one, super contribution rates from employers has increased from 10.5 to 11%. The superannuation balance cap, that is the amount you can have in a tax-free pension, has increased from $1.7 to $1.9 million. So naturally some positive news there for anyone planning to retire in Australia. And even those expats who might be a bit concerned that super might not be enough to provide for retirement, well, you're getting closer and closer to what that income actually might look like going forward. So certainly an important one to be aware of. Outside of that, we have also finally received a bit of an update on the tax residency rules in Australia. In summary, really no surprises there. No major updates or concerns that anyone or any of our clients really need to be mindful of. I have written a bit of an update on my website, so you'll find a link to that blog post in the show notes. Make sure you check that out, and of course reach out with any questions that you may have. In Singapore, we have also seen announced the update in the tax rates from 2024 and beyond, and that is we're going to see a 1% increase in the tax rate above 500,000. So that will increase from 22 to 23%. And for those earning above $1 million, that tax rate will increase from 22% to 24%. Of course, relatively marginal increases, but certainly ones to be mindful of. And if there are any deductions that you're not already capitalizing on, of course, reach out and let's explore what options you may have to reduce that tax liability here in Singapore. So that's a bit of an update for you on the second quarter of this year. As I said, it has been a positive quarter. We remain cautiously optimistic going forward, but again, focused on that quality end of the market. Certainly some great opportunities in the market for investors. We really don't believe that anything is fully priced at the moment. There are certainly some attractive valuations. So of course, reach out, let's book in a chat and book in a bit of a meeting and explore anything else we need to update for you. Thank you very much for tuning in. Really appreciate you giving me your time. I look forward to speaking soon and reach out with any questions. Thank you.